Welcome to episode number 97 for the National Land Realty Podcast, where we discuss all things land. Our goal here is to inform, educate, and entertain those of you who own land or are interested in the buying and selling of land throughout the United States. My name is Mac Christian, and I am the Chief Marketing Officer here at National Land Realty. I'll be your host for this episode. Now, today is a very special treat. This is something that we do once per quarter. We talk to the Chief Economist for Farmer Mac, Jackson Takach. Now, if you are unfamiliar with Farmer Mac is the secondary market for land loans and agricultural loans throughout the United States. You're probably more familiar with terms like Freddie Mac and Fannie Mae for residential loans. This is how people get money for land and for agriculture. So when it comes down to economics of land, Jackson Takach is probably one of the best minds in the country. We get the honor of sitting down with him once per quarter. So that means this episode gives you a tremendous amount of value. Now, we're going to talk today about the Great Wealth Transfer. You're probably more familiar with terms like, or sorry, not the Great Wealth Transfer, the Great Land Transfer. I was going to make an association there. The Great Land Transfer, and you're probably more familiar with terms like the Great Wealth Transfer. We're going to talk about that topic here today. We're also going to talk about inflation, and we're going to talk about interest rates. Now, I have recorded this intro probably 10 times now in order to get the phrasing right here, because I wanted to throw a disclaimer on it. And I don't want to beat around the bush with it, so I'm just going to get the disclaimer out of the way. We talk about inflation, and everything nowadays is a hot button topic, which president did what and who has what side. And I'm not entering that fight on any level. And I don't think that Jackson wants to either. We are talking pure economics, what causes what, cause and effect, and how things happen. By no means do we seek to minimize the impact that inflation has on anybody's pocketbook. There are those that this has really, really impacted. It's impacted everybody. Let's just face that. But I just want to make sure that I throw a disclaimer on it. We're talking pure economics, and I don't want to get on anybody's wrong side by doing that. I'm not recording this again, so this is my last disclaimer that I'm going to try to get out of the way. Just know that we're having an economics conversation. We don't get into things like greedflation, because that would mean we would have to go through every company's books to see who has inflated prices abnormally. We're just talking about general economic environments, and we're not getting into politics. And so just know that we're sensitive to the impact that inflation has had in your lives. And by no means do we seek to take any stance on anything like that. So that's the only disclaimer I'm going to throw on this. It's one of those, like, it's good information, and it's actually fantastic information. So stay tuned, listen, and thank you. And special note, 3 episodes from now, we will have our 100th episode. Follow us on Facebook, follow our page, and we'll have announcements for that live podcast. Thank you, and enjoy. Okay, so once and again, we are here with Jackson Takach, Chief Economist for Farmer Mac, and it's a weird thing in my career to say one of my favorite things to do now is to talk to an economist. I didn't see that coming in my career, and it's definitely one of the highlights of the quarter is getting to talk to you. So very excited. What we do in these sessions is we talk about what happened last quarter, what is happening in the coming down the pipeline, or the predictions. Right, this is where we get to throw on the crystal ball and sort of what we are looking at for the year. But Jackson, I sort of wanted to ask you, we always kind of do this, just give a brief little rundown of your background for people who have not caught our previous episodes, and tell us a little bit about yourself and what you do with Farmer Mac.
Hey, Mac, thanks for having me back. And I totally feel you on the joys of talking to an economist. I think my wife would agree every day. So she just has that pleasure every single day. It's great to be back. Thanks for having me. You nailed it, Chief Economist. I'm also a VP of Strategy Research Analytics over at Farmer Mac. I've worked in ag finance and sort of the things impacting the rural communities and lending across the agricultural spectrum for almost 20 years now. All that time at Farmer Mac. So it's been a great journey to spend at just a wonderful company that I have the pleasure of working for. My group covers all things related to the economic picture, how that might impact borrowers, landholders, investors, the entire food supply chain, rural infrastructure, you name it. We're really focused on the things that are going to be impactful to those local economies, as well as how that might fold back into lending demand, loan products, things on the horizon that might impact those. And if that weren't enough, we have the joy of thinking about long-term strategy, doing research projects, trying to understand maybe the future of ag tech or lending tech, different policy initiatives, how that might impact the business. And then we do modeling and reporting as well. So we got a lot of hats that I'm pleased to get to wear throughout the day here at Farmer Mac. And I've got several degrees in economics and finance and all the kind of like background to be able to do that stuff. And it's just been a real joy to see Farmer Mac, which if you don't know Farmer Mac, for your listeners who don't know that much about Farmer Mac, it's a secondary market, so not a primary market. You can't walk into a Farmer Mac office. We are really behind the scenes working with financial institutions all across the country. We are focused on the ag mortgages. So that's a primary for us, is it being a secondary market for ag mortgages, but also for things in that ag supply chain. So how's food being produced and making sure that there's an adequate secondary market for lending in that space, as well as rural infrastructure. So things like rural electric cooperative finance, telecommunications, broadband, renewable energy, all those wonderful things. Seen this company really grow throughout my tenure here the last 20 years. It's been a beautiful thing to watch and be a part of. And we work with lenders across the country to help bring better solutions, more capital at really great terms and costs to borrowers nationwide.
Yeah, and for those who not just using my name on, I'm not joking, man. Growing up, it was like there was the Fannie Mae and Freddie Mac were the two names that were kind of synonymous with loans and lending, and now it's Farmer Mac. I got enough nicknames. But so the parallels to draw are, if you've looked in the news and you've seen things on Fannie Mae, Freddie Mac, those kind of things, secondary markets for loans. So really, when we're talking Farmer Mac, Jackson here works for the organization that kind of makes the wheels go round as far as lending goes in agriculture. This is the primary means that people get loans when we're talking farm, ranch, that kind of thing, or rural infrastructure. So no minor thing that you're working with as far as the industry and the amount of people that you help out. But we're here today to we talk about sort of economically what we've seen, and what the outlook is, but and I want to kind of we bounce bullet points back and forth here, right? Like Jackson and I were kind of usually he throws out some topics that are kind of hot button things that he's seeing, and I want to go in order. So one of the first things that we brought up was there's been a lot of conversation over the last few years about the great farmland transition, and it kind of falls in line with the great wealth transfer as well, right? Where we're talking about a generational shift in economics, where you're looking at the old guard handing off to the new guard. And, we've seen all these reports on the great farmland transition. And one of the conversations that keeps happening is, will younger generations pick up the torch, or what's that going to look like? Or what's that transition going to look like? And so one of the talking points we decided to cover here today was, will it ever happen? What are we looking at? And so I guess that's the question I'm going to pitch back to you, Jackson, is will the great transition in farmland happen, and what is it looking like right now?
Yeah, it's a very dense question, right? To talk about sort of this massive, we talk $3 trillion in total value, the total value of the land and buildings on farmland across the country. So $3+ trillion. How does that turn over, and how has it turned over in the last, say, 5 years? Fortunately for us, we have a little bit of an advantage compared to maybe some other asset classes, because the USDA surveys farmers every 5 years and asks a lot of very detailed questions called the Ag Census. And we just got some results from the most recent Ag Census. So 2022 Ag Census year, the USDA released all those results earlier this year, back in February, and we're able to start to get a sense for what's happening with the demographics in agriculture. How are those things changing, and how might that lead to the transfer of wealth to the next generation, or will it result in sales of those assets that might free up and create more supply of farmland in the marketplace for any number of people. It could be other families who want to buy it, could be investors outside of farming who like the asset class. And I'll say the results from the 2022 ag census show that we were continuing to see that age, right, come into agriculture. We talk about it pretty much everywhere. You can talk about it in ag circles. It's farmers are getting older. You know it when you go to ag producer meetings and you kind of look around the room and you see more gray every year. You see that come through in the ag census. The average age of a farmer increased by a couple years after this most recent ag census. And you're seeing this like hollowing out of the farmer demographics. So you've got maybe a growing number of older farmers, so 65 plus, and you've got a growing number of younger farmers, 45 and under.
So when we're talking about this great transfer, the first question I wanted to ask you is whether we are talking strictly food producers, or are you looking at, and I kind of designate it as there's farmland and then there's ranch land. Are you looking at both, or is it strictly farm as in producing what would we say, plant-based food supply or plant-based commodities? I'm really kind of stumbling over this, but you get what I mean. Like, is it farm, or is it ranch, or is it both?
Yeah, it's both.
It's both. Okay,
it's both. So yeah, we're talking about the full 900 million acres of both cropland, so stuff that's growing, annual crops or permanent crops, perennials, trees, vines, those kind of things, as well as the ranch land that's out there housing, the millions of heartbeats in our livestock supply chain. Probably not so much when you go up the supply chain. So if you go to more of the food processing, right, there's more of a corporate mechanism in there. So it's not necessarily family held. So farmland, about 60% of it tends to be family held. It could be in trusts. So we're seeing more of those types of structures. So that's another indicator that maybe we're edging closer towards some transition in some of the ownership and operating of these assets. But there's still a lot of corporations. So an increasing percentage of corporation structures in farming operations themselves, which is telling me like, hey, like in that production space, in the land ownership space, still a vast majority of assets are owned at the individual or sole proprietor level, right? So 60%, 60 plus, it's coming down, but it's still a high percentage are owned by those individuals. And that's across cropland as well as pasture land. More of that in the further up you go, it's a lot more structured to persist depending on who's running it. So you could see ownership change and it would persist. It's either a trust or it's a corporation. But land itself, still very, very much an individual asset.
So that was going to be my next question is, and I'm just, I'm really good at leveraging rumor on the street stuff. And that's why I'm not the economist, I'm the marketing guy. So the conversation keeps on happening that family farms, you have, senior family members running the farm, and I'm just going to use farm to cover it. So nobody throw anything at me listening. I'm going to use farm to cover agriculture in general. And this can be ranch and farm, right? So
yeah,
or I'll just say agricultural
farm and ranch.
We'll take the PC route here. So where the conversation keeps on going to, there are older agricultural landowners that are, kids don't want to pick up the torch and move on, and the hope is there that somebody else comes in and takes over, the ag land. And instead, the conversation keeps on going to the corporations are getting more and more of a stake or more capitalizing more of the market. Is that the case? Do we see that in the numbers? Like, is the percentage of individual ownership yielding to corporate investment groups, or is that it? Can we see that in the data?
Yes and no, but the reason why it's a yes and a no. So corporations are a larger percentage of controlled land and then the value of ag production. But most of those corporations are family held, right? So it's the family structuring as a corp for any number of tax reasons, for estate planning reasons, for, thinking about transition to other ownership, right? So they're deciding to structure as an LLC or a state corp or however they're trying to do it. So it's not what you think of. I think a lot of people, when they think corporations, are thinking, large conglomerate, multinational, sort of headless state organizations, but most of the corporations that we see in agriculture tend to be smaller hold sizes. They're more family controlled and family owned, and the organization structure is more of a business decision rather than a, hey, we're trying to exit and somebody else is coming in and buying all this land. Some of the surveys out there around land values, and so I look at Illinois, right, has a great land survey. Iowa State does a good one. Purdue does one for Indiana. Some of the questions that they ask in these various surveys are like, well, what kinds of transactions are happening and who's buying them and why are they up for auction or for sale? You're starting to see an uptick in, hey, if someone's buying this, it's because of an exit, right? So a family's getting out and the person buying it is another farmer, right? So the number one reason is there's a farmer who's passing away or exiting farming for whatever reason, but the number one buyer of that land is another farmer in the area. So far, it has been largely a transition from one farmer to another farming entity. But there's a growing interest in other investors in the space, right? So you see maybe that start to tick up from low single digits to middle single digits in terms of the percent of transactions that are going to larger investor bases.
Right. And that's an important point to make is like, yes, corporations are buying land, but those corporations are just the business entity itself rather than, like you said, the kind of nameless, faceless beast that you have in your head of like the big corporate entity coming in to buy it out. But they're getting more of a stake at the table. I mean, it's food production, right? It's all business, right. And you're going to see some of that, but it's not as numerically as large as conversation may seem in that place. So, and if I'm hearing you right, when you're talking about the average age of agricultural landowners ticking up, it's that handoff is not necessarily happening right now. Is that something that's anticipated? Like, is there any way to even project that? I mean, because you're talking about conversations around the family dinner table. So is that something that you're kind of keeping a pulse on? And is that something that you're tracking or maybe projecting?
Yeah, it's almost like actuarial and kind of a very somber conversation. Like you don't want to think about like, well, we're all getting older. I mean, that's not a great conversation to have, but that is part of the math. Part of the calculus is you can only live so long. And the average age, the percentage of farmers who are over the age of 75 is, continuing to increase. And so we saw a drop in the age range between 45 and 55. That percentage went down quite a bit in the most recent ag census, and then 65 and up increased quite a bit. So you're seeing the baby boomer generation kind of move through the farms and increase in age. So there's actuarially kind of what's going to happen in terms of life expectancies and sort of the transition of assets and decision-making there. But what I think is more tangible from a data perspective is seeing how many more producers are working on the farm today. And the use of things like the trust or a corporation to establish younger producers in the business making or decision making process within the business. When you look at the percentage of farms with more than two operators or producers who are making that decision, we saw a pretty sizable increase between 2017 and 2022. That tells me that younger folks are kind of being brought into the operation, maybe taking over a part of it or working as a function, marketing, or doing, CFO role or those kinds of things within the organization, even if the primary is still an older, maybe head of household kind of thing, grandmom, granddad kind of keeping the farm alive. They're bringing younger folks into the operation to start to learn the business and maybe eventually take over the business. So that's increasing. Even though we saw the overall count of farms go down, we saw a lot more farms with multiple operators in the 3, 4, and 5 range. The other piece of data that I look at is how many loans that we see where a trust is actually holding the land rather than, mom, dad, grandmom, granddad, like the, individuals. And that continues to increase as well. So we're seeing that land kind of move into entities that will survive and have, sort of tax implications. And that tells me that people are thinking forward. They're looking at this and they're trying to structure their debt, which is probably going to outlive people like who, I have a 30-year mortgage. Maybe I hope to make it 30 years, but a lot of this debt will extend beyond the life expectancy of many people. And they're thinking through, what does that mean? How do I protect the asset? How do I protect the future business owners? And I'm seeing that accelerate out there in the marketplace.
Got you. So one, if I'm paraphrasing you correctly, is that the transition is happening. It's just maybe at a slower, more gradual pace than what's been talked about in the past, where I think the assumption was that land would be just handed off, people would exit, and there would be this new wave of younger, ag land owners that would kind of step into the role. But what's happening is it's more of a gradual, kind of almost an apprenticeship situation where the older generation is maintaining some level of control, maintaining some level of control as they go along. And then if you're seeing an increase in trusts, I mean, the best functionality for that is a handoff. You're setting up to where there can't be a contest, right? There can't be any argument about how this is handed off. When you set up a trust, it's going down exactly as written. To where like the older generation is kind of dictating of, okay, we're going to do it. It's going to be this way. No one's going to argue, and we're going to maintain some level of control and then gradually hand off. Is that kind of, am I hearing you right there?
Yeah, I think that's exactly right.
Okay.
Who's to say what will happen at that moment when we go into probate or estate settlement? Will the inheritors, the next generation, will they want to operate the farm? Will they want to own the farm? Will they want to sell out to cousins or siblings who maybe want to have the ownership, and maybe, hey, I just inherited 5 million of farmland. I don't know what to do with it. I want to be a 5 millionaire, right? Like there will certainly be some of that. I think there'll be a lot of working out to do in that situation, but there's a lot of under leveraged assets out there in that world as well. And there's going to be, I think, a lot of buyers of land should that land need to come up for sale to sort of settle some of those estates. I think there's a great deal of support both from the lending side. So, lenders who will add additional leverage. A lot of that land is owned free and clear. When you look at, average, the leverage on farmland is something like 12%. So you take the total amount of farm mortgages, the total amount of farmland assets, and say, divide one into the other, you get 12%. But on farms that have leverage, it's more like 40% or 50%. And then we have so many acres of farm and ranch land that has no debt at all, right? And so when those assets come up, there's going to be, I think, an additional demand for leverage. So as family members need to maybe figure out what to do to get the operators consolidating in that family entity. And then there's going to be some that come up for sale just to settle those estates. And I think at that point, we're going to see a demand increase for both debt on the farm as well as farmland for sale. And the demand for that farmland, I think, is pretty robust.
Yeah, I was going to say that's a conversation that, man, we could probably do 2 or 3 episodes on sort of like a generational handoff, and just from families that I know personally. Like when you have the older generation handing off, and there's more than one kid, it's rare that there's not some kind of disagreement, and and really the way to take care of that is with a trust. It can still be contested, but the outfits that hand off without something like that in place, like it gets nasty fast. And I think there's good reason that you would see a slower transfer from older generation to younger generation because of that. I think it's being seen more and more. And anytime you have more than one landowner in one area or for one piece of land, I don't want to say it guarantees conflict. That's an overstep, but a lot of times there's a conflict, especially that initial handoff where, either it's someone, passing away or just exiting completely. Like that whole next step, it tends to be like, it can be dicey if you don't have it all set up. So it makes sense that it's happening, I guess, slower than previous conversations. But yeah. So is there any kind of, with the average age getting older, are we anticipating sort of maybe a delayed kind of thing, or the handoff is slow, but is there a point that we're anticipating that there's going to be like a huge shift?
Yeah, so I wouldn't ever project a huge shift, right? I tend to think of these things in more trends and slower, because like you, I've been hearing about this and talking about this for probably a decade, and expecting a lot more land to come up for sale in the last 10 years than actually came up for sale in the last 10 years. And so I think the next 10 years, I'm trying to learn from the last 10 and say like, well, hey, maybe these things do take more time, and seeing these structures come up in the conversations with the tax and accountants and, tax preparers and lawyers, maybe the message got through, right? And so there's a lot more prep that's going to happen to slow things down. That's where I've kind of learned from my last 10 years for my next 10. But I do think in the next 10 years, we're going to see a sizable amount of land transition out. All right. So from one owner to the next, or within the trust, start to see some of the ownership change in accordance with some of these legal documents. And I think as part of that, as it gets into a younger generation, there's going to be a demand for additional debt, right? So I look at both of these things. We have, unlike the housing market, right? So if you take all the value of houses, $40 trillion of houses, and you divide the amount of debt on those houses, you get something like 28% leverage. Well, again, agriculture's at 12, right? So part of the reason why so many houses have so much debt is that younger people have it. They can't afford it. They're kind of spreading those payments out into the future. As younger farmers kind of take ownership of some of these assets, they're probably going to need some of that leverage to pay off some of the assets into the future. So I see kind of two things happening. One, we continue to see this land move into legal structures that will exist beyond our own life expectancies and sort of transition into the next generation. But that next generation's also going to need additional financial support from capital providers to sort of make it all work and deal with any of those sort of contentious issues where maybe one group within the trust needs to be bought out in order to make things go. I think there's going to be capital available and needed to sort of make that process work out. So I'm looking at a sort of a 10-year horizon where we're going to see this start to play out. And in that, you could see quite a bit of accumulation of wealth kind of move across, as well as leverage come into the sector to sort of rebalance compared to other asset classes. I mentioned residential, it's at 28% leverage. So is commercial real estate, right about the same level, right at 28%. And then farmland's at 12. So we're a little bit behind because I think most of those assets are owned by older generations who don't need as much leverage as younger owners of assets.
Well, I was going to say too, just the operations of any piece of agriculture. I mean, what the combine costs $250,000 to $500,000. Like to come up with the cash flow to just keep things updated, there's going to have to be some leverage into the marketplace, right? Like that's one of the things that keeps it going. And I don't want to knock the older generation, but there's a lot of cases where it's like, no, that tractor's good enough, and the thing is 100 years old. So there's going to be that where you got to keep the business running, and you got to bring in leverage to be able to do that, or look at cash flow or anything like that, where you get a new generation and there's going to be new technology and an acceleration in what we're looking at with technology. There's going to be those that have adopted technologies that maybe older generations haven't, that will come into the marketplace.
Yeah, I think if you're a provider or maker of some of that equipment, you think of some of the efficiency gains and some of the older or from moving from some of the older technologies, either equipment or seed or other practices. I think a lot of operations have sort of modernized, but I'm positive you're right. There's some room to increase productivity out there on the farm. And again, I'm looking at sort of a 10-year, maybe not the next ag census, but maybe the next two, we will see some sizable demographic changes in farming operations. That bimodal split where you've got sort of the average age, I think, went up by 1 year. So it was 5-year difference between 2017 and 2022 when the two ag censuses were done. The average age went up by 1 year. So people are like, oh, the farmers aren't getting that much older. But when you look at the percentage going over 65 and the percentage under 45, those two things, you're kind of hollowing out that middle and the average doesn't move. Well, that group on the right, the 65 and older, those numbers are going to change in the next 10 years.
Yeah, they would have to. All right, so let's jump into everybody's favorite topic. Let's talk a little inflation.
Yeah.
Yeah, I say that I that's obviously facetious. It's not everybody's favorite topic, but let's jump in.
You talk to an economist, right? Like we talk about stuff all the time.
It works.
Yeah.
So what we saw over the last year was inflationary impact on everything,
Yeah.
and there's always the assumption from the top down. Everybody, it always gets looked at from the surface of like, oh, food prices are going up. But as we've tracked it back through, any kind of the where the costs come from, it starts with everything from fuel to the cost of inputs. One of the big ones was fertilizer over the last few years, where the cost of natural gas went up, and that's what drove fertilizer up, because you use natural gas into making fertilizer, and then that drives up the cost of food because you have to mark it up to. It's a huge chain of things that causes the inflation. Where are we sitting right now as far as inflationary impact? Because it's been such a large conversation, and then it seems to have leveled over the last, let's say 6 months. Where are we right now, and what are we looking at?
Yeah, I mean, I think inflation was such a big story in 21 and 22, right? When you think about, we were in the middle of the prices going up, and it felt like a slow burn, I think, at first. And then I think people who were actively buying stuff were like, what do you mean, Federal Reserve? Like, what do you mean transitory? Like, I'm paying more for everything across the board. And if you looked at the categories, right, it could be goods, services, the cost of housing, you name it. There was inflation, price pressure in every single category, with the exception of maybe, I think, in 2021, personal travel was still pretty low because we weren't quite back to normal after sort of a rough 2020. But every category was lit up, right? We were seeing price increases in every single category. 2023 became a little bit of a different picture. Prices were still elevated, but they started to stop increasing. And I think where we got to in 2024, and kind of talking with people and family, friends who live in different parts of the country, everyone's still uncomfortable with how prices are. But when you ask, like, hey, are prices still going up? They're like, well, not really. They're not going up, but they're too high, right? So I think that's where we got to in 2024. It wasn't that people are still saying, hey, all the prices are continuing to go up like crazy. There's still a few categories where they are, but by and large, it's the stuff, the sort of day-to-day transactions, prices got to be much more stable. They're going up, but maybe it's not as noticeable as it was in 2021 or two. But that doesn't really help your perception of what things cost, right? People are still perceiving things cost a lot more. And I think that impacted sort of the consumer psyche in 2024. So where we are today, we're kind of in a 3 to 4% sort of inflationary world. The Federal Reserve, other central bankers, other economists think we need to be closer to 2%, right? That's a stable level that we can handle in an economy to see prices go up 2% per year. That's kind of roughly the growth rate. So we feel like that's a sustainable level. We haven't quite gotten back down. And whereas 21, everything was lit up, inflation and everything, price going up and everything. Today, prices are kind of stable on everything with the exception of two things. One, our insurance. That one's hard for me to describe. I think it was just repricing of car insurance and things that just cost more the last couple of years, and the insurers are adjusting to actuarial costs of things being higher, so they raised the price of insurance. So that was kind of a shocker, but probably not a persistent problem for us. Probably kind of a step function. It went up and now it'll stay there for a while. The other thing was housing, and housing represents about 40% of our collective spend. So when housing costs more, we all feel it, and it can really push the overall measures of inflation up. So if you take out housing and you just look at sort of like everyday spend, inclusive of food, inclusive of energy, we're kind of hovering around that 2 to 2.5% range. It's the housing piece that's really given us a lot more pressure. And then that pressures everybody, the economists, the Federal Reserve, voting members, it pressures politicians. And it's really the cost of housing that I think is kind of pressuring the inflationary story right now.
Yeah, well, and when we look back at the inflation story, I guess this is a question based on a premise that I'll lay out is questioning whether there's some accuracy to what I'm about to say. Is we go through where I even hate reflecting on it because it's so political and everything. But like when we talk about lockdown, right?
Sure.
People don't travel, and so your utilization of gas goes through the floor. No one's
Right.
using. And so your fuel impact on the economy drops through the floor. You have retail goods and everything drop through the floor. And you have 2 years of this, essentially. And then things open back up, and the preparation for not only the fuel utilization, all of a sudden people are using fuel again. People are traveling, they're driving, they're interacting more. And the market wasn't prepared. And the supply chain of the market wasn't prepared, and the reserves weren't, and there probably was some preparation, but I mean, who can account for what it's going to be? So
Yeah.
when that starts happening, everybody's demanding it, the price goes through the ceiling. And the price of fuel, and I'll throw in supply chain as well. If that infrastructure is not in place with the lean supply chains that we have now, meaning, it used to be you have reserve warehouses that would store a bunch of junk, and when people order it, you could ship it out of different locations. Now things are moving to much more cost efficient levels, to where it's like they don't store as much. So to get more of the product, you have to be on the ball. And if you're not on the level to do that, the price goes up in order to get it from other locations, or to produce it as it's requested. That drives everything up. So you see this period since lockdown ends, you're talking, what, we're like 2 years out of like really lockdown. That's not a huge amount of time in terms of making a huge economic shift. Those cost increases are a result of that. From what I've can surmise, is that kind of what consensus is?
Yeah, the two big drivers. You're talking about supply side and demand side drivers,
exactly
right? So you have two things that can happen. Either you don't got enough stuff, right, and that's going to drive up prices because competition for the stuff you do have. We definitely experienced that. I tried to buy a washing machine back in 2021, and it was a struggle to find a washing machine because the snarls in the supply chain kept most of the washing machines somewhere else in the world. They just weren't here. We weren't manufacturing them. The plants were closed or whatever reason. So we had supply side problems across the spectrum. Gasoline's an interesting one because at one point during the 2020, if you remember this, the oil futures prices went negative, meaning you got paid you had to pay to make oil, right? It wasn't you got paid by someone to make oil. You had to pay someone to take your oil.
Right.
And that was just strictly because there was nobody buying gasoline. So everything got backed up, and it was like we had a storage problem. So supply side hit really hard in 2020, 21. And then we started pumping a lot of money, like call it helicopter cash, right? It was like, let's keep this economy going and make sure that people without jobs can still pay their bills. And we put a lot of cash out into the marketplace in 2020 to 2022, and that's what I think a lot of people still talk about. Like, oh, there were too many. It was too easy money. The easy money was out there, and then at that point you have too much money, right? So everyone's trying to buy stuff because they have a lot of money, and you see the prices go up because of that demand, right? For goods because I have a lot of extra cash. So we saw both back to back. You had a supply side disruption and followed by a demand side pull of inflation. And that's really what drove that spike in 2022 and 21 into 22 was the kind of handoff of supply problems in inflation to demand problems in inflation. And today, a lot of those things have been, so the supply situation's much better for goods, energy, all those kind of things. That gas is back down to $2. Inflation or fertilizer prices have come back down as a result of some of the international disruptions, maybe slowing a little bit. So there have been some things that have cured on the supply side. It's really that demand side, particularly in housing, where I don't know if you tried to buy a house recently. I have several friends who have. I've been fortunate not to have to look at housing right now, but renters and buyers are having a hard time finding housing. And that has kept the level of pressure up in the housing markets. And there it's probably a combination of supply and demand really driving that story.
Yeah, I was gonna say we've really seen the worst case scenario as far as economics goes, where it's like we have money, everybody wants stuff, but we can't get it, so that makes the price go higher. It's like our own demand is driving the price, and it's like there's not a lot. You can't exactly mitigate demand. You can't like hop on a news conference and be like, hey, everybody stop buying stuff for a couple months and maybe things will level. Like never happening.
Yeah.
And then
my brother-in-law during the pandemic built a deck on the back of his patio, and he was like going through to lumber at that time. If you remember, lumber was going through the roof. You couldn't find
like
any
gold. Yeah, it was like as much as gold.
Yeah, it was insane. And so the guy said, well, here's the price, and I can do it probably in 6 months. But if you pay me 3x or what, I can't remember the exact number, but if you pay me 3x, like we can do it next month. And so ever since then, I was like, you're the reason why we have inflation, right? Like you wanted it, you had some extra cash, you were spending time at home, you said, get it done. And then you weren't alone, right? A lot of people kind of went through that thought process. And so the price for stuff just kept going up as we all bid up that price and looked around and said, well, I want it, so I'm going to go get it. And you're right. There's really no way. You don't want to say stop that, right? Like, hey, people, like, don't spend money, because the opposite is deflation. And trust me, that's the worst outcome. Like low inflation, I'll take that any day of the week over deflation, because that is such a psychological monster to fight. When people see prices going down, their first reaction is great. Their second reaction is, I'm going to wait and buy that later because I think the price is going to go down more. And so you have this double whammy of, well, now people are making less money because their prices that they're selling for stuff is going down, but no one's buying anything because they're all going to wait and buy it later. And just ask Japan, like, deflation throughout the 1990s and 2000s, they have spent 30 years fighting it. And it's just not a place we want to go. So when I hear people talk about like which prices would come down, I kind of want to say, like, yes, I hear you, but maybe we just hold prices and let your income come up a little bit. And that's a way we can get to a good, healthy level of prices over the next 2 or 3 years, rather than see prices come back down, which is a very tricky knife to catch.
I was going to say, because then what you look at is, yes, you can get your groceries for less, but also what you do for a job is going to be less as well. You are going to make less money. And then you're not going to buy as much because of that. And then things are going to drop faster. You're right. It's a snowball effect that is, as a whole, you can't catch up to. And I guess a sort of a policy question is, because the first thing everybody looks at when you talk inflation or deflation is the government. And I always joke that the government is, or, especially if you look at the Federal Reserve, it's a one-trick pony. Like, you've got interest rate that you can control. Are there other controls that can even work with that, or besides quantitative easing that we saw, like, in the lockdown era? Like, are there any other switches that they can even pull?
Yeah, it's a fairly limited set of tools in the toolbox for the Federal Reserve, which it's why it's a common, policies of a broader brush, right, than just monetary or fiscal. It's got to probably work together in some capacity to really achieve effective ends. But I will say, you look at raising interest rates, it took some time, but I think it is having the achieved effect, which is people are slowing down, not maybe necessarily individual consumption, but capital consumption is slowing, and people are putting money maybe into bonds instead of trying to invest in new businesses, which ultimately is the aim of higher interest rate environment, is to kind of slow down, suck out some of that capital and say, hey, why don't you just put it over here for a minute, right? You can get a good return just by putting it over here. You don't have to try to like create economic activity. You can be rewarded for your capital just by setting it over here for a minute. And it's taken time, but it does appear to be starting to achieve those end results. You don't expect this stuff to take 1 day, 2 days, 5 days. I mean, this is like, a long-term process, and the Federal Reserve members know that, the banks know that, right? But it's hard. And people expect like, oh, well, you raise interest rates, so like we're good, right? No, it takes a little bit longer than that. It is working, but it does take a little bit of time to get through the cycle.
Yeah, and there's no way to be the good guy in that scenario either. Like, you either raise interest rates and you're the bad guy because you've done that, or you don't raise the interest rates and you let the runaway market implode, and then you're definitely there's no question you're the bad guy at that point. And it takes time. Of course, that doesn't alleviate the concern of consumers who have been, especially like, as you look at income levels, you look at that like low to low middle class income, they get nailed. And waiting for those, like you said, looking at the inflationary impact to level off and wait for incomes to meet that time that it takes for incomes to meet where inflationary impacts have reached, that's rough. Like, and that's more of that's a holistic question on what people are getting paid, and who raises what. Of course, to pay them more, you have to raise the cost of goods to counteract that. That's a longer process. So there is going to be some impact on different economic levels. And it's like you can't under empathize what that impact is, but of course there's going to be frustration in that level. Like that's not going away.
Yeah.
That's going to be a thing. And what we've talked about previously too is you mentioned interest rates, which I do want to jump into because that's another big one. That has slowed the real estate market. I mean, we work in real estate. We've seen what 20 to 31% drops nationwide in both residential and what we work in with rural land.
Mm-hmm.
We've seen those impacts nationwide. It's not a screeching halt, but it is a jarring difference on what we've seen. And it's because of all of this, right? It's the interest rates and the inflation and that kind of thing. So before we jump into interest rates specifically, I wanted to ask sort of you mentioned we're sitting at 3 to 4% inflationary rate, which you're right. That's just a little higher than what we usually see of 2 to 3% of where we want to be. But I mean, even anything, when I worked in finance and stuff, we would talk about like 3 to 4% is a good thing to bank on, because then you're not going to be low, and you can miss, but you don't want to be low when you do. So what are we looking at for the year ahead, do you think? And I realize this is crystal ball time, miss or beyond, like that's the hot seat kind of thing. But what do you think that we are looking at as far as where we're headed?
Well, it's really going to depend on what happens with housing. So if people can so much of that number in the housing space is based on survey data. So as people are feeling one way or the other about their housing situation, so will go inflation. So if we can see maybe people start to feel a little less, it's almost like you want less optimism. They're looking at their housing and like, well, the price of my house is going up. The cost for me to rent someplace else is going up. Therefore, there's a lot of inflationary pressure on my house. And they respond by saying it's going up. If you take some of that optimism out, then all of a sudden maybe they're saying like, well, my prices aren't going up. I expect, the value of my home in a rental equivalent basis will be about the same for the next 12 months. And so I hate to say it depends, but that's a classic economist answer. It really is going to depend on how homeowners are responding to some of those questions and what happens to the supply of housing in the next 12 months. If that starts to weaken at all, we can either see more houses come into the supply, or people start to sell even though maybe they don't want to. They may want to sell because their lifestyle is changing. They're moving to a different location. So at some point, someone's going to start selling their houses. You can't just sit tight forever at 3% mortgage rates. So once that sort of levee breaks, that's when I think you're going to see the inflation come back down under 3%. Could it be in the next 6 to 12 months? Absolutely, it could be. Could take a little bit longer than that, kind of depending on the strength of the overall economy for the next 12 months. So I don't think we're going up. I'm pretty, I guess, bullish in that respect. I think there's probably more downside pressure for inflation than upside pressure for inflation, but it may take a little while to crack the psychological hold on the cost of housing. And so much of that is survey based that it will take people changing how they feel about the housing market before it starts to show up in the data that the Federal Reserve is going to take a look at. Long-term interest rates, I think, hey, those could start to move up and down a little bit. I think they're going to be, pretty range bound. I don't think we're going to see huge swings either way, up or down. So I think it's going to be a lot more trading around a certain range in those places. And then the Fed's going to be totally data dependent. So if the economy weakens a little bit, if you've got inflation coming down, hey, maybe the Fed starts to take a little bit of air out of the tires, and maybe we start to see a 5.5% become 5% or 4.5%. Different people are saying different things this year. I think it's a really a story of the data, and we'll know in a couple of months exactly what that outlook looks like.
I was just going to say, when it comes to interest rate, which is sort of the next thing, we go from inflation to interest, is depending on the week in the news network or the economist that you hear, it's either going up next week or it's coming down next week, and it's in small increments, but we're sort of in that, it's almost like a Bollinger Band scenario. Like it's like,
bounces
wave at a certain time and see where it gets to. Is that kind of where we think that things are going to stick around for probably the remainder of 2024?
I think that's a likely outcome, is more range bound sort of trading in between various pieces of data. So something comes out the inflation print is a little high, people are going to start to think like, well, maybe we're not going to see interest rate cuts. But then maybe you get something about GDP coming in a little weaker. Well, maybe we are going to cut interest, right? So I think that is the type of oscillation that we're likely to experience because this is such untrodden territory. We don't know, typically when you see low short-term interest rates higher than long-term interest rates, an inverted yield curve, that's almost a perfect predictor of recession. But we've been sitting on that for 23 months now, and we
Right.
still haven't seen a recession. So I think we're dealing with new economic factors that we're going to have to, I think, live with a little more uncertainty, a little more volatility within certain parameters because it looks so different today than prior periods. In the past, I think we would have said, oh, yeah, we're heading for, everyone did say, I said, we're headed for a recession, right? Look at the inverted yield curve. Look at all these problems that are kind of building up. Well, it turns out consumer was pretty resilient and we kind of sailed through a lot of those problems. And here we are, and all the signals that we used to look for to tell us what was going to happen next aren't really telling us that with a great deal of certainty. So in those worlds, you kind of live with a little bit of chop, learn to live within a certain boundary, a certain range of values. I think that's likely to persist until we get very clear signals that some of the liquidity is out of the marketplace. The consumer maybe has bled through some of the extra cash that they have. You see signs of it, but it's not like, they're kind of like flashing. They're not really steady red. And that's going to continue to create a little bit of uncertainty in the inflation and the interest rate trades.
I was going to say, like, we lived with these economic laws for so long, or I mean, economic theories, economic laws, however you want to call it. And the inverted yield curve was, kind of almost gospel, and it seems just such an interesting thing that you think about economics as being monetarily driven and not so much behaviorally driven. I mean, you'd have to take behavior into account, but the fact that sort of a behavioral shift could change something as strong as inverted yield curve kind of predictions, and we're kind of there. It's like it's a very unique territory that, like, obviously the philosophies are changing, right?
Yeah, I think, and the cause for the inversion too. I think we're going to learn that people are going to study this for the next 10 years of PhD. Dissertations are going to be written about, like, why is this time different, and explain it with a mathematical model. And it'll be really interesting to see how that research shapes up, because I do think it will affect the next inversion and the one after that. And, like, will we continue to say, hey, when investors bet sort of short on the economy, like, that's a pretty good sign? Well, we may learn that it's more policy driven. And if you see a policy signal like fighting of inflation, perhaps, right? That's because that's kind of what drove the inversion today. That's a different expectation than what you can expect if there's no policy change to interest rates. If it's not policy driven, yes, it's a good signal. If it is policy driven, no, it's not a good signal. And the researchers going through school today are going to study that. I think do a great job of sort of explaining it away. But that's the way I love living at the front, right? I like to see new experiences. I like to see interesting things change, because the past is only a good indicator of what might happen tomorrow. I like that tomorrow's a little bit. I thrive in uncertainty and enjoy that a little bit as you think about some of the variety being the spice of life.
Yeah, it's like we get into the habit. We have short memories. We tend to forget the things that happened yesterday, but we also try to use the past to predict the future.
Yeah.
And so, we saw housing getting impacted, and it was like, oh, well, we had this great downturn. It's going to be exactly like that. Like, no, it was completely different than that this time. And then the next thing happens, and it's like, well, it's going to be exactly like that. Like, no, it's going to be completely different from that too. But it's kind of just a perpetual thing that we kind of combat. So inflation for the year. If I'm hearing you right, probably going to settle between that 4 and maybe high 5. Do you think 6 range for the duration of 2024?
For inflation or for interest rates?
I meant interest rates. Yes.
Yeah. Yeah. No, I think we're probably in that 4 to 5 range on the longer term rates. Maybe we eke up a little bit north between 5 and 6. But I don't anticipate 7+ on like the 10-year treasury, and nor do I anticipate 3- on the 10-year treasury. Right. So we're kind of in that range of where we are today, kind of bouncing around. I think the signals are kind of likely to keep us in that range bound territory. And then the federal funds, again, I think there's more probability of a decrease than an increase. So I think a great neutral rate might be something more like 4.5, but how quickly can we get there is going to be very dependent on the other data that comes through economic channels.
So last, and I want to be respectful of your time. I always try to do this, but I want to hit you with one last question. The conversation that we've had almost every time we've talked is plateau in land values.
Yeah.
It looks to be holding strong. I think we said it last time, like, hey, the crystal ball worked. We got it. Well, I say I mean, I listened to you and I repeated it. But we see this plateauing effect of we hit sort of capacity on land value prices. Are we looking at sticking there? Do we anticipate a adjustment in land values, maybe a decline in land values, or are we going to stick around in that strong zone that we've been sort of through the duration? Is that kind of what we're seeing in terms of, and obviously one county is different than the next county.
Yeah.
That stuff's going to have some variance, but as a whole, are we still looking at that kind of plateau zone?
I think generally yes, with a couple of caveats, right? So it's very supply driven right now. It's not interest rate sensitivity so much as it is how much land is there and how many bidders for that land are there. So there's still a lot of cash coming off of pretty strong years in the farm economy. So 24 looks a lot like 23 from a balance strength, the balance sheet perspective. We've seen some erosion in some parts of the supply chain in some geographies, but still a lot of cash coming in from a couple of strong years on the farm economy. So all that's supportive. If people can hold on to their land and they don't need to sell, they're probably not going to sell right now. So I think supply is generally going to maintain sort of this equilibrium status where stuff that does come up, there's enough buyers for it. And so you see the trade laterally instead of up and down. There are some, I think, special and unique circumstances. You go out west, you see changes in water policy finally sort of working their way through land markets. You see lower nut prices, particularly almonds and walnuts, affecting sales of properties in parts of San Joaquin Valley in California. So those kinds of things I think are going to continue to, I don't know, dislocate. I think what was maybe you think of a level playing field where some of those changes have been cooking for a while. Well, now we're starting to see that land come up for sale. And we're learning like, hey, if you didn't have two sources of water, maybe the value that you thought was here is actually here because of a water thing, not because of land value overall is changing or there's some negative, impact to land values overall. It's just starting to adjust to the market, and we're seeing some of that land come up for sale, and that's going to drive those equilibrium prices. So I think there are special circumstances in certain markets, but overall, I think you're probably right to expect more lateral movement rather than trading up and to the right or down and to the right.
Excellent. Yeah. And to your point too, like was it pecan prices or pecan farms in California dropped significantly at the beginning of the year. It's probably the same thing that you're just talking about. But hey, like I said, want to respect your time. As always, man, I love these conversations, man. So I can't express enough appreciation for you taking the time to chat with us. And I know that the information is useful for those out there listening. So I just want to express my gratitude and thank you very much.
Hey, it's a pleasure, Mac, always. Keep inviting me back. I'll keep coming back.
Excellent. I like that. I haven't chased you off yet. That's good to know.
All right. Good to see you. Have a great one.
This concludes episode number 97 for the National Land Realty Podcast, discussing the 2024 Q2 economic outlook with Farmer Mac Chief Economist Jackson Takach. You can learn more about land ownership and the buying and selling of land at nationalland.com. And wait a minute, it's episode number 97, which means we have 3 episodes until episode 100. And stay tuned for that. We're going to have a live podcast. Really hope you can tune in for it. It's going to be fantastic. We're going to have some of our agents and partners throughout the country. Our CEO, Ronnie Richardson, will be on, as well as some surprise guests. I'm keeping it secret because I don't know actually if everybody can attend. So we're going to call it a secret and hope everybody attends because it's going to be great. But the ones that do attend, it's still going to be great. You get it. You know what I mean. Okay. Thank you and have a great day.